That being said, let's get into miners going into debt. Yes, crypto markets are down, but the mining difficulty across networks, especially Bitcoin, continues to go up. Now, if miners aren't as profitable as they used to be, which of course Bitcoin miners, as we've been paying attention to, have significantly dropped over the past year, then you have a problem where if they want to continue to expand, they have to get the funds from somewhere else. Where are they getting it from? Well, Battered Bitcoin miners increasingly turn to debt financing. Raising debt rather than equity to fund growth is being seen as more attractive, analysts said, but not everyone has the option. And this is really the problem that we have to talk about, which is kind of interesting. Actually, it was funny. If you guys own a business and it's like listed publicly, you may get these types of calls. I know that as a crypto miner, I do get these types of calls. Most of them go to voicemail or whatever, but one got caught and went through on my, while I was driving yesterday. So I entertained it. And it was one of those where like, we see that you're a small business owner. I have a loan shark essentially on hold. Let me ask you a few questions and see if you qualify. And of course, the first question was, how much revenue do you have in sales? And I was like, none. We don't do sales. And they were like, well, you don't qualify. But there are basically companies out there trying to give out debt, but it's very difficult, especially as you have to do like usually over $15,000 a month, that sort of thing to even qualify. You have to have like an established credit record, of course, for whatever company. One of the reasons we do rent, which we've talked about before, is because that does build up credit for the LLC. That's kind of part of the reason we do it, so that later if we do need to get some sort of credit line to invest in equipment to spin up faster, that's what happens. The hard part is like, unfortunately with cryptocurrency, it's very difficult to move around and get traditional financing. So it really isn't an option for everyone. And the other problem with that we'll go back to is, how do you sit fundamentally on that, right? Because you're essentially, in a lot of cases, utilizing some sort of traditional financing third party, typically a bank, to fund something that is fundamentally against the institution that you're borrowing from, which is just wild to think about in the first place. Debt financing will be a positive catalyst for the shares of the publicly traded crypto miners whose stocks have tumbled in the last year as crypto and broader equity markets saw significant sell-offs, according to Wall Street analysts. Due to their high correlation to prices of the assets they mine, crypto mining stocks saw rapid appreciation last year as Bitcoin prices soared to an all-time high. However, the rally evaporated this year with lower Bitcoin prices, rising network hash rate, and brutal competition. With markets off their peak, access to capital has also become somewhat restricted for the miners who need large amounts of capital to stay competitive and grow. Quote, access to the 3 M's, money, megawatts, and mining rigs matters more than ever, and based on investors' concerns around the capital needs, accessing capital efficiently seems to matter the most right now, end quote, said investment bank BTIG's analyst Gregory Lewis in Research Note this week. One way miners will be able to navigate this environment is by delivering on their promises to fund growth in more efficient ways by borrowing money rather than just raising equity. Quote, we expect funding concerns for some miners to be addressed in the near term as the Bitcoin mining financing markets matures, which should be a positive catalyst for miners who are able to access debt financing, Lewis wrote. This was echoed by investment bank D.A. Davidson's analyst Chris Brendler in a recent research report. Quote, we expect improved execution of mining operations and broadening access to debt capital to be positive catalysts for the miners near term, Brendler wrote. As industry matures, debt capital is preferred by investors given its non-dilutive nature. Indeed, offering equity in the current market has often not been kind to those who share price of miners. Most recently, shares of TeraWulf, which uses 100% clean energy to power its mining operations, tumbled about 30% on April 12th after the company said it would raise $20.6 million by selling common stock. Another miner, DigiHost, said in March that it would raise $250 million through an at-the-market equity program, which allows the miners to sell shares from time to time. At the time, DigiHost's market cap was less than $100 million, making a capital raise of $250 million, even over a period of time, a sizable amount. The shares of stock fell about 18% on March 4th, according to FactSet data. That hasn't stopped some of the miners from keeping their options open to equity raises through ATM offerings, which is at the market offerings, by the way. Most recently, Riot Blockchain, Bit Digital, and Mawson Infrastructure all filed to sell up to $500 million in shares. TeraWulf also said later in April that it plans to sell up to $200 million worth of shares through the at-the-market program. And in February, Hut 8 launched a $65 million at-the-market offering, and Marathon Digital filed to raise $750 million. The share prices didn't react as negatively right away, given the filings were shelf registrations, meaning there was no present intention to immediately sell all the securities being registered. However, most of these stocks have traded down with the market since their announcements. So, what are they saying? What have miners been doing or were trying to do during a bull market and they got in a little late. We're seeing basically they started getting these registered a little too late in a market that's going sideways, which obviously dilutes your consumer trust, I suppose, your retail trust, that sort of thing. So instead of doing that, they're shifting to the idea of taking on debt instead of selling shares in the company. That's essentially all that's really happening here. And a lot of that has to do, of course, with the lack of people that want to purchase the shares, hence why the stock prices on all of these are going down. Once again, I'll always remind you guys, if you're looking at this from an investment standpoint, if you want to invest in a mining company, be very careful, because now you have multiple points of failure. Not only do you have the point of failure of just the company itself, but you are dependent on the crypto markets as well. So what should you do instead? Well, you should just invest in the crypto markets directly. And that's really what you should be doing. In light of such market conditions, raising debt through creative ways has become an emerging trend among miners. Using specialized Bitcoin mining computers called ASICs as collateral for loans has become popular among miners to fund their growth plans, as well as using mined digital assets as collateral. So we do have to talk about this too, because earlier I was talking about taking the traditional debt, from like an institution. We do have, of course, all the DeFi options that allow basically miners or anybody that participates in cryptocurrency to put up their cryptocurrency as collateral and get a loan on that, usually separate from all the banks and so on. How much of that is being done, though, is kind of questionable. How much liquidity is available there, too? Maybe we'll get a better idea. Most recently, Bitcoin miner CleanSpark raised $35 million in equipment financing, backed by 3,336 new S19J Pro Bitcoin miners. Meanwhile, Australian Bitcoin miner Iris Energy secured $71 million in equipment financing, backed by 19,800 Bitmain S19J Pro miners. And miner Greenridge Generation raised $81.4 million in S19J Pro backed loans. Now, I don't know how you get these loans necessarily, because it's super interesting. And I don't think it would apply for to necessarily your GPU miners. I don't know if that's a possibility, but I guess that's something you could look into at a smaller scale, potentially. Quote, although spreads and advanced rates are no longer improving in this environment, we are still seeing increasing opportunity to leverage secured debt solutions such as Bitcoin-backed debt facilities and rig collateralized equipment financing, end quote, Brendler wrote in his note. The sector has also matured with an expanding set of lenders that are starting to include more traditional financial, that's what institutions for the first time, end quote, he added. And I think this is what's really starting to happen, is the traditional financial institutions are trying to get in, because to them, well, how do I put this? To them, it's a safer way to invest in cryptocurrency than directly investing into it and giving, of course, their traditional financial investors, retail investors, options to participate within cryptocurrency without directly participating in cryptocurrency. And I think that makes a little bit more sense for traditional finance there. But however, BTIG's Lewis warns that access to attractive capital or debt terms that are more favorable for the miners may not be possible for all of them. He believes larger Bitcoin miners such as Riot, Marathon Digital, Core Scientific, and CleanSpark will have multiple options to raise debt, including asset-backed and potentially corporate debt. And so a lot of this can be frustrating from multiple standpoints, I think, as individual miners, home miners, etc., because obviously the more equipment that is online, the more competitive the network gets, making it more difficult to mine any cryptocurrency that's being mined by one of these large firms. And since they have the ability to collateralize all of this equipment, they can shoot the difficulty way up faster than we can stay up with them, right? And that means that essentially it kind of damages, the smaller investors, the smaller miners, and so on pretty significantly. And it's exceptionally frustrating when we consider that, for the most part, what crypto is, or what we have in hope for with crypto, is that it does enable the individual to have some autonomy there. And we do it through mining. So it feels like obviously some of that autonomy, financial autonomy, gets taken away when these people are basically able to utilize traditional finance, etc., to massively increase the sizes of their farms really quickly, regardless of price of cryptocurrency, right? So from my perspective, I'm definitely more dependent on the price of cryptocurrency than, say, one of these companies in relation to being able to expand, right? And that's kind of where we sit at. The ideal situation, because I get this question like, will GPU mining still be around? Will CPU mining still be around? That sort of stuff. And I think that'll be around for forever. We talked about yesterday, I believe, during my live stream on twitch.tv/blindrun, a project called Ixion. And it's similar to TON in the fact that to generate basically volume for a lot of these small projects, even if they do plan to move to something other than proof of work later on, like Ixion, for example, they basically have a distribution method to keep it fair of mining. So you have like 5 years on that particular network, for example, to go ahead and mine. I think that'll continue to be around for quite some time. Now, I think that moving towards CPU specific mining and cell phone mining in particular are the ways to go for a more distributed hash rate power. Now, that means that everybody that's mining, ideally, obviously, isn't going to make as much as they would if they're building large farms out, etc. But what you get from that is massive distribution. So if we really want to change things, we really want massive distribution and availability to everybody. That's why I think, obviously mining on a cell phone would be ideal in the end game, right? In the end game. And then obviously having some sort of easy to load, low requirement nodes for consensus, maybe built into the miner, that sort of thing. That's really where you want to push towards. Now, will you be as profitable as a GPU miner when these things start to inevitably move this direction? No, but we aren't necessarily trying to be millionaires as much as we are trying to distribute the wealth more evenly, I think, across society and bring up the entire society, because if we can bring everybody up, then that's where you start fixing a lot of the problems. That's my personal opinion, fundamentally, from there, and where I see mining going in the future. But GPU mining, all that sort of stuff, I don't think is going to go anywhere. We also have, of course, AI to get solved through proof of work with proof of useful work. We have different, stuff like folding at home there, which isn't really, that could be integrated, of course, as well. I don't think it's going to go anywhere. Do I think it'll get tough? Yes. And when the tough comes, the tough gets going, or whatever, essentially, we will have to survive some bumpy times. And I think we're about to have a few of those probably through, 2025, something like that, till the next halving. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.